The Hidden Wealth Tutorial Series. Live well, keep more, simply, safely, and effectively. Financial decision making. Micro versus macro. The banking financial industry is in the business of making money. The information they provide is to sell their products. It is not intended to give us economic education. We see the part of the picture that they want us to see to close the sale. This leads us to decisions on a false bottom line. Decisions on a false bottom line cannot achieve our best results. We don't ask you to take our word for it. In micro versus macro, we show the other half of the picture so that you can judge that for yourself. Being micro is focusing on and making decisions on a small part of the big picture. Typically, it happens without our knowledge or consent, since important parts of the decision are left out. This is what the banking and financial industry does when they direct our attention to the superficial features of their financial products. Critical details are missed. For example, in financing, they focus our attention on loan rates when the actual loan cost is more than double the rate. The longer the loan period, the lower the payment, but the higher the interest cost inside the payment. Today, most car loans, new and used, are for 6 years. The actual cost of a 6-year loan at a 4% rate, which at the time of this writing is less than the current best rate, is 11.2% per year. In investing, they focus our attention on the gross rate of return, when the true net return, which they do not show you, is about half that, after accounting for all investing costs. All the financial and economic costs that determine the true bottom line are not disclosed to us, so we can't account for them in our decisions. As a result, we fall short of the expectations we hold when making the decision. We fall far short of what could be. Contrary to the micro approach, infinite banking concepts, what we simply call legacy banking, takes the broader macro approach to identify and reverse financial and investing costs, to make them work for us instead of against us. It promotes personal empowerment by enabling us to become less dependent on banks and the financial industry, and to knowledgeably apply a few basic economic principles in our decisions. We will show you what they are and the difference they make so you can be the judge. First, let's put what we've said to the test. Loan cost. Bank loans are amortized. Amortization schedules that itemize the principal and interest cost over the loan period are available online. We often use Bankrate.com. Here's the actual cost of a 6-year car loan at a historically modest loan rate of 4%. The monthly payments total $4,693 each year. In year 1, the interest paid is $861. This equals a year 1 loan cost of 18.3%. Now, in year 2, the interest paid is $791 for a cost of 16.8%. In year 3, the cost is 13.4%. Year 4, it's 9.9%. Year 5, it's 6.2%. And in year 6, it's 2.9%. The total of payments is $28,161. The total of interest paid is $3,161. And the average yearly interest cost equals 11.2%. The stated rate of 4% has a true cost average of 11.2% per year. Now, this is caused by the upfront loading of interest payments and is standard with bank and credit union loans. Net investment returns. The S&P 500 Total Return Index has the highest volume and return average of commonly used investment indexes. Its 20-year stated average is 9.3%. Now, we'll start at 10% and deduct investing costs at modest estimates. Stated average return, 10%. Fees averaging 1 to 1.5% or minus 1.25%. Taxes to be paid now or later, minus 2%. Assumes a modest 20% combined state and federal rate. Down year cost average, minus 1.6%. Now, this calculation reflects the actual down years over the 20-year period. Stated averages reflect the percent of change, not the dollar value. After a down year, the percent is on a smaller balance, so at the same percent, the return is smaller. 8.4% is the actual average return on this index, equaling a down year cost of 1.6% per year. Term life insurance costs, minus 0.5%. When analyzing the premise of buy term and invest the difference, this cost must be included. The 10% stated rate has a true net return of 4.65%. Account statements do not account for taxes, down year costs, or term costs. Often, they show deposits as gains when, in fact, they are costs. Due diligence is essential. Even at modest bank loan rates and investing costs, those costs are more than double the net investment earnings, before we account for credit card, other debt, and other avoidable costs. This is what happens with micro decisions that follow the banking and financial industry lead. Yet, this could be completely reversed. With legacy banking, loan principal and interest can be fully recouped to earn interest and dividends on all of it. For us, a value that more than triples the net investment earnings. Now, our conclusion is this: buy term and invest the difference cannot work as advertised. Financial and investing costs must first be recouped. Otherwise, gains coming in the front door flow right out the back door. Now, let's define 3 essential economic principles in a financial decision. The first one is macroeconomics. This teaches us that every financial action we take creates economic reactions. They are reactionary costs. Some are seen, some are unseen. The macro approach is seeing and accounting for all the parts of a financial action, including the economic reactions, to enable us to reach our best possible decisions. Next is the big one: opportunity cost, considered to be the single most important concept in economics. Opportunity cost is a reaction to everything we do financially. It's as constant and ever-present as gravity. Being unfavorable to them, the banking and financial industry does not acknowledge or disclose the opportunity costs caused by following their advice. Now, here's a few of them. When we spend or allocate money, we lose the value we could get with a different option, such as enjoying the vast difference between suffering a cost and recouping the cost to grow for us. If we don't account for this, we're working with a false bottom line and cannot achieve our best results. Now, for example, the cost of paying cash is a commonly missed opportunity cost. If we were to pay $25,000 cash for a car, we lose all future growth on the full $25,000 from day one on into forever. In 30 years, it's a cost of over $81,000 at a modest 4% growth rate. Now, bank loans are paying cash on the installment plan. We lose all future growth on the total principal and interest we pay to banks. The total cost is the principal plus the interest plus the lost future growth on the principal and interest. In saving and investing, taxes, fees, and down years are cost against gains, resulting in lower actual returns and long-term lost growth. Now, with a different option, those costs could be recouped and invested for growth. When this opportunity cost is not quantified in the decision, we're again pointed to a false rate of return, and we cannot know what our best decision would be. All of it can be easily measured to properly evaluate the decision. Yet, without being presented with an alternative, it's rarely done. All of these are relevant opportunity costs. Legacy banking can recoup them to save, invest, and grow. The third economic principle is an essential part of infinite banking concepts, legacy banking. It's velocity of money, the velocity of money multiplier effect. In effect, it's like having more money. Earlier, we stated that when we allocate money to one thing, we eliminate all others. Velocity is the one exception. It is a simple and safe use of money that provides two or more benefits from the same dollars at the same time, as opposed to the usual one benefit per use of money. Just think about the power in that. Banks use it routinely. Here's an example. A bank makes a car loan. This earns the bank interest on the initial loan outlay each year of the loan term. Then, starting with payment 1, as each payment comes in, it goes right back out in a new loan. Those dollars are now earning another rate of return, then another, as they come back in and go out again. Turning the same dollars over and over again during the same loan period is how a conventional bank earns about 34% per year on a 4% car loan. As a legacy banker, I can do that too. With a conventional bank loan, my payments go to the bank over the full term, gone forever. By becoming my own legacy banker, I'm the banker and the customer at the same time. The payments I make, principal and interest, go to me. That enables me to create velocity. If I borrow from my own legacy bank to buy a car, perhaps go on vacation or do home improvement, and make the same payments to my legacy bank that I would have to make to a conventional bank, I earn what the conventional bank would have earned. The money is recouped. It's back into my own legacy bank where it earns interest and dividends for me. Now, this is a velocity of money value I could never otherwise get. It does two things. First, as it earns money for me, it is recouping the opportunity cost I would have suffered with a conventional loan or with paying cash. And second, I can reuse it immediately. Now, for example, I can reuse it to pay off, pay down, or avoid credit card debt. Another velocity. Now, the same dollars in my legacy bank are recouping car loan costs, recouping credit card costs, and earning interest and dividends, which recoups opportunity cost, all at the same time. A total return value of well over 20%, all without tax. Legacy banking is the only known way to do that, simply, safely, and effectively. That is why banks are legacy bankers. Banks own and use over $204 billion of dividend-paying whole-life cash value to do it. The banking and financial industry prospers on micro decisions, yet life itself is macro. Now, we have a lifetime of wide-ranging, demanding, and evolving wants and needs to fulfill, with limited resources to do it. Limited resources cause us to make compromises in our decisions. And without knowing in advance what real-life events are in store, we make choices which leave us at risk when the unexpected happens. Forcing it down into micro-decisions, whether we are aware of it or not, causes economic reactions and financial limitations that are detrimental to our financial well-being. We need to apply countermeasures. Legacy banking is a countermeasure to the wealth-stealing financial and economic costs of life. It recoups them to work for us. Recouped money, along with utilizing the power of velocity to get multiple benefits from our dollars at the same time, helps reduce financial pressure and alleviate risk. It turbocharges the value of our money. The fact is, all of us, individuals, families, and businesses, have a personal economy. It includes everything we do financially. And while the tendency is to look at gross returns on savings and investments, our true bottom line is the net result of all our financial actions, after accounting for all our various costs against our savings and investment returns. That is financial truth, the true indicator of how well we are doing. That is the foundation of our best decisions. Doing an honest profit and loss analysis on the overall cash flow in our personal economy and applying a few basic economic principles opens the door to our best possible results. Without doing that, we will never know We are simply following the banking and financial industry lead. It's a lot easier than you may be thinking. It looks like this. Common items in a personal economy include living expenses, mortgage or rent, car, home, and liability insurance, health insurance, life insurance, car payments, savings, credit card and other debt, 401k, IRA, and other investments. We have one pool of money allocated to all the various products and services we use to fulfill our wants and needs. It's all related. Everything we do financially affects our decisions on everything else in the pool, resulting in the net performance of our entire personal economy. Some make money for us, more of them cost money. A profit and loss analysis on our total personal economy is the only way to find our true bottom line, to see how well we are doing. Let's do one. We'll start with person A, who follows the standard banking and financial industry lead on cash flow management. Person A using standard bank-led cash flow management. Now, while the amounts and the items will differ among us, this represents typical personal economy activity. We've got cash flow item, cash flow amount, actual interest paid per year, and interest earned in 1 year. Savings and investments. The cash flow amount $500 per month, interest earned in 1 year $335. This is the net of a 10% gross rate of return after accounting for the modest investing costs shown on slide 3. Car payment at $460.41 per month. The actual interest paid per year is $525. That's the average interest paid per year on a $25,000 simple interest bank or credit union car loan at 4% for 60 months. It includes only the loan interest cost. Car insurance, the cash flow amount $132 per month. The actual interest paid per year, $82. That assumes a $1,500 annual premium paid monthly at 10% interest. Credit cards. Cash flow amount $173 per month. The actual interest paid per year $413. This is below the actual national average. Total cash flow $1,266.41 per month. The actual interest paid per year $1,020. Interest earned in 1 year $335. The effective rate of return in 1 year on the total monthly cash flow equals minus 4.5%. It would require increasing the invested amount to $1,870 monthly at 10% gross rate of return to earn enough growth to offset the interest being paid to the banks. Or it would require a net rate of return of 35.7% on the $500 monthly investment. That's just to break even, to have gains offset the cost. The summary, despite a high gross investment return, Person A's overall personal economy is losing, regardless of income. At higher income, just add zeros. Saving more and taking more risk just to offset the costs is beyond reasonable expectations of success. To really win, to prosper, step 1 is managing life's costs. They must be recouped. Now let's see how that can be done while still fulfilling our wants and needs. Next, we look at the results of Person B, who created a legacy bank and is using the infinite banking concept. That is the only difference. Total cash flow is exactly the same. In illustration 2, Person B, the legacy banker. Again, we have the same cash flow items and amounts, but now we have interest recouped instead of interest paid. Legacy bank, cash flow amount $500 per month. Now we have premium deposits into cash value instead of savings and investments. Car payment $460.41 per month. Interest recouped in 1 year $524.92 plus interest and dividends. Use a policy loan to buy or pay off the car, then make the same payments to your legacy bank. Car insurance, $132 per month. Interest recouped in a year, $82. Use a policy loan to self-finance premium, then make the same payments to your legacy bank. Credit cards, $173 per month. Interest recouped in a year, $413. Use a policy loan to pay off or avoid credit card debt, then make the same payments to your legacy bank. Total cash flow, $1,266.41 per month. Interest recouped in a year, $1,019.92. The effective rate of return in 1 year on the same total monthly cash flow equals plus 6.71%, tax-free. Each policy loan payment goes into your own legacy bank cash value, just like making savings deposits. Now, this recoups the principal and interest you would pay to the bank and enables you to immediately use it again to recoup more costs, to grow as safe money, or to invest in anything. Now, these are velocity benefits as discussed earlier. The 6.71% personal economy return is from the recouped interest alone. In addition, the recouped principal and interest earns interest and dividends without tax, which recoups the opportunity cost that would otherwise be lost. Before taxes and fees, a $500 monthly investment would have to gross 34.35% each year to recover the costs and net the legacy banking return of 6.71%. After a modest 20% combined state and federal tax rate, it takes a return of 41.9% to net the 6.71%. Now, while an investment may earn 41.9% in a given year, it is very rare. It won't work. Legacy banking is the only known way to do it. The personal economy. The banking and financial industry focuses our attention here. Savings, and here, on the 401k, IRA, and other investments. So we tend to look there to see how well we're doing, even as the gains we may earn there are offset, likely exceeded by our investing, financing, and economic costs everywhere else. The financing and economic costs of life's needs will never stop. The costs of saving and investing will never stop. There will always be fees, taxes, and down years. On top of that, some investment options lock up our money with heavy penalties. Then, the loss of use of our money causes financial pressure, debt, and opportunity costs. That is the big picture they don't show us. Those costs will always drain off our savings and investment growth unless they are recouped, and there is only one known way to do that. Legacy banking. With the macro approach, it focuses on maximizing the economic efficiency of the total personal economy, allowing our savings and investing to give us the true growth we need. Now, we just saw an increase of over 11% rate of return, net, without tax fees or additional out-of-pocket cost on the entire personal economy performance, not just one part of it. It all comes down to positioning ourselves to work with sound economics. As Nelson Nash, the founder of Infinite Banking Concepts, said, it's simply a lesson in logic. If you understand the problem, you'll know what to do. So, what do you think? Do you have questions? Would you like to see how legacy banking could work for you personally? Contact us at info@mymoneyflow.com. Thank you. P.S. Some may consider zero-interest car loans as ideal when they are available. To see a quantified comparison of all financing options and get some additional economic insight, we invite you to watch our short video, Legacy Banking in a Nutshell.